If I just held the asset, I would have. Let's first analyze the position size, which in this case it is 1000 USDT, just to make things clearer and easier to calculate. Also, at the start of the period, the supposed return was 6.something%, and that was per annum. The duration investment in total was around 3 months, as you can see here. And there was a settlement price at 89K, but the market price at the end was 95K. Okay, now, so let's make some calculations here really easily. As you guys will be able to take a look here, the return per the term, which in this case is 3 months, would be 1.5%, and that is easily calculated by the next formula. Okay, so the number of months divided by the total in a year, which is 12, and we would multiply that by the annum return, alright? So in this case it is 6 point something, so we will leave it at 6, and that would give us at 1.5 something%, right? That was the return that was promised for me, which in this case it is really low, as you guys can see. But I was that dumb and I decided to accept that. So at the settlement date, we had a value of around 1000 USDT of our asset, right? But in this case, the settlement price was 89K. So in this case, when there's a dual investment and you in this case lose because the market is above the settlement price, then that converts the assets that you have into USDT in this case, or into the other coin. So they gave me 1000 as my capital, but in this case, we also got the return per the term, which in this case, it is this return here multiplied by the value of the settlement price, alright? So let's pull this down and it'll be relatively easy to calculate. As you guys can see, it is 1000 multiplied by 1.5%, which in this case it is 1.5, and then we will divide it by 800. So the return would be 15 point something USDT, right? And finally, at the end of the period, we would have received 1015 point something USDT. In this case, I didn't receive any assets. I just received it all in USDT, even though I might not have wanted. Now let's make the calculations for if I just held the asset. This will be relatively easy as well. Let's pull this down so that we can see it. We will use something called an arithmetical rule of 3, which is very simple. In this case, so that we could find the asset value at the market price, we would have just multiplied the asset value, which was at the settlement price, which was 89K, by the market price, which in this case is 95K, divided by the settlement price, which in this case it is 89K. So if we pull out our calculator here, let's take 1000 times parenthesis 95. We don't have to put the 3 zeros because they will be cancelled anyways. So this is the result, right? 1067.42, rounding the number. So that would have been the asset price if I just held the asset instead of making dual investment here. Then you guys can see if I just held my assets, I wouldn't have lost that much. In this case it is $50, but it could have been way more if I invested more. So maybe in the future you might be able to analyze the situation even better than me and see what are the market trends, what is the market doing, macroeconomics, and other factors that might decide whether or not the price of the asset will go up or down. And you might evaluate if an asset is going to go up quite rapidly, right? So another point of consideration was that I wanted to own the asset, right? But in the end I had to sell it because this was something like a futures contract. So if that's the case, then you might have wanted to just stake it plainly, or nothing more than just go to work and buy more when it dips.